There's been some debate recently in the press as to the value of technical analysis. Let's take a look now at this and indeed set it against some of the fundamental analysis that some look at in the markets to determine future performance. Ron William joins us now from RW Advisory, where of course you are a technical analyst. You have been pretty much all your adult life, but I know as well you do also read some fundamental analysis when looking at your TA. First of all, I want to ask you, who undertakes technical analysis when looking at the markets?
Well, a growing global community of financial market professionals, even some leading academics are now starting to come up with some important studies on validating the value of technical analysis. And of course, many of the mainstream society that are wanting to advance their financial market intelligence. These are the growing trends as we see it at the moment.
Why are they doing it? What's forced them, if you like, into this corner where you have to look at technicals as opposed to some other aspects of analysis?
Well, there are many advantages that it has. Of course, I've been using it all these years, and also it's something I focus on as part of the IFTA technical analysis group for their education focus. And what we find is that it's a key shortcut to strategy, to achieving what everyone really wants to within the market. And that's not necessarily in isolation. It is also complementary to existing strategies. And that's really through the understanding of crowd psychology. And there's 2 points here. One, how crowds drive trends. But two, how the crowd perceives all of the market information out there, whether it be fundamental, whether it be economic, or anything of the such. So really it's a tangible, hands-on fact of price information that needs to be watched. Second, of course, we have timing for the day-to-day trader, entry and exit levels, particularly in FX and commodities. But even, let's say, the institutional investor is also focusing, let's say, on the stock valuations. They want to buy at a cheap level. They need to know it's either attractive cheap, and so it's going to go up in value, and so they need market timing for that, or it's cheap for a reason, get the hell out and look for another stock. And then last but not least, risk management has become more important now than actual alpha performance, just because it's become harder now to produce those results. So if we think about risk reward, if we think about diversification, and if we think of just portfolio balancing, technical analysis can help with across all of these risk management metrics.
Yeah, okay. Let's take a look at the long term and some of the cycles. When we've spoken to you before, you're very keen on cycles and the way in which markets perform, and in some cases repeat what's happened before. Explain more about this and the way you apply it.
Well, here it's very topical for our discussion to explain how investment styles rotate according to the market cycle. So actually there's a little bit of a deterministic causality here from the financial markets onto how we invest or trade. And what this shows is long-term cycles of up to 20 years alternating on the Dow over the last 100 years. I've got some overlays down below just highlighting the cycles and historical volatility. But what it shows is that in the red periods, the weak trends, high volatility, the investment strategy that is preferred is active market timing and astute risk management. So we've seen that overall. The most recent time was between Y2K and 2009, and obviously since it's been blue sky territory in terms of this bull run that we've seen thereafter. But the green areas, the one I just described, post-2009, is the strong trend, low volatility, and so passive buy and hold, and really resilient views about efficient market hypothesis and a challenging of market timing and maybe technical analysis-related techniques tend to come back into fashion. Now, just incidentally, I mean, two things I want to mention here. One, in 1973, when efficient market hypothesis was popularized by the Machiavelli book, Random Walk, down Wall Street, that was after a 20-year economic kind of golden era previous. So a lot of the strategies that were recommended did work for the most part, but then the 10 years later, less so. And it's something that we need to keep in mind, you know, that things don't last forever, nothing is linear, and we do need to have our finger on the button just in case change happens. And fast forward, 2018, February, we had the flash crash, 1,600 points in 15 minutes on the Dow. We need to stay alert to change, particularly according to my cycle metrics, between 2019 and 2020 onwards, asymmetric risk increases for the downside, not the upside.
Let's move on to the next chart, because I'm interested in this perhaps more than anything else. It's the idea of crowd psychology. It's the large numbers of people all moving together. How important is this?
This is everything, and many behavioral psychologists understand this and share a lot of commonality with technicians in this area. We believe that human emotions drive markets, and the average day person by themselves might be rational, all things being equal, but put them against the mania of the crowd and think about the real booms that we've had, which have led to busts, the Y2K boom and crash thereafter, or even last year's digital currency boom, which we have yet to see what will happen thereafter. But still, people do go crazy in crowds, and when you amplify it with money, fear and greed, that's really what's driving us here. That basically incapacitates our logical brain and leads us to make emotional decisions. And so we believe that the past behavior is often a reliable indication of future trends. Hence we get herding and groupthink. But even this isn't linear, and according to cognitive bias theories and Nobel Prize winners in this area who have proven that there are certain behavioral brain states that actually lead the pendulum to swing between euphoria on the top side and pessimism on the bottom side, and that triggers the fluctuations in a cycle that we get in financial markets and in nature. Interestingly, something that we should all be aware of is that when euphoria is at its real top and we get that greater fool theory kick in, that's the maximum risk factor. So it's the time that we can make the most amount of money, so it's quite sexy for a lot of people, but we can also lose a lot of money too, so heightened risk is required then. And on the low side, pessimism, that's when we're feeling really bad about the market and it's the hated market, guess what? That's the maximum reward opportunity, and many famous investors have gone on the record and actually made that point.
Something else we've discussed before, and that is the short term, the medium term, the longer term trends, because you apply different metrics to different parts of the cycle. Explain how we go about applying technical analysis in these different scenarios.
Well, this is everything really, and if there's one of my experienced secrets, it's learning cycles. And when I started early on, I didn't do this. I was focusing more on the short term, and many of my mentors said, long term, big picture, you'll get a lot further with doing that. And the point here is that you need a top-down process, or a process, a structured process at that. For most people, particularly investors, they have a strategic overlay with maybe tactical changes to that view, and then of course the day-to-day traders, that they're more active, so they'll be between active and tactical. But essentially all this is long-term, medium-term and short-term, and this is all rooted in the Western grandfather of technical analysis, Charles Dow, who spoke in his principles of technical analysis about the need for multiple cycles, 3 to be exact. And what's interesting here is if we think about moving averages, we can use practical hands-on indicators like moving averages. The 200-day represents an average 1 year, the 50-day measures a quarter, and the 20-day is a one month. So there's no real secrets as to why these numbers are so popular. They're just calendar dates or for investment horizons. And now the side point here, just in terms of interpretation of this, if I'm coming in looking at this with a linear model, this will just look like random noise, much like a doctor looking at the heartbeats on the computer machine. It's only through training and following the rules that we understand that diagram in the top right-hand corner is a heartbeat and variations of that. Last but not least, nothing works in isolation. That's why cycles are so keen. That's why it's so dear to me within my analysis. And we live in an interconnected world, not least in the financial market. So it's really important to understand all 3 time frames.
Let's bring up your next chart, because that really sort of displays what all this looks like on a trading screen when you look at the short to longer term. And in fact, you've also got to illustrate here something with a traffic light system. Explain your thinking on this multi-cycle trends and moving averages.
So it's important for IG audience to understand how to do this on their trading screens, and it's a question I'm often asked. And obviously if you have 1 or 2 screens, it's even easier, but the long and short of it is, look at 2 to 3, and my preference is 3 time frames each day. before placing a trade or investment. Again, that strategic, tactical, and active time frame. You can choose which time frame you want to use according to the style of investing or trading you're doing. But ultimately, think of for a strategic outline, a monthly 10-year chart. Not going to change much, but at least you'll be able to see the big picture. Medium-term, weekly 5-year chart, and on the lower side, a short-term daily, or for some people, intraday chart. But either way, having an understanding of all three and understand there's a fractal relationship between them, you will see patterns appear and repeat through each time frame, and that's a real edge for most technicians or just people who are overlaying chart analysis. Now, on the right side here, we're kind of doing the same thing, but instead we're looking at moving averages, just basic moving averages. Think of it as a traffic light system. Red for danger, orange for pause and consider what's happening, and then green, of course, for go. The 20 and the 50 and the 200, as I alluded to in the previous slide, are key calendar dates for investment horizons. And what it shows now on the S&P 500 is on the monthly basis, the S&P 500 is outperforming. But the quarterly average, the 50-day moving average, is sliding down. So what some people would read as a bullish crossover signal is false. It's wrong, and it will lose money at this moment in time. So be aware that both averages need to either rise or fall in the direction of the crossover to give you that robust signal. And so this is really important for people who are misusing technical analysis and then critiquing it wrongly because they don't know what they don't know. It's really important, particularly when you're trading and investing, to know how to avoid false signals just as much as it is to actually trade the right ones. And last but not least, just bear in mind the 200-day moving average at 26.40 or thereabouts. That will be the most important line in the sand.
Okay, moving on, and the next slide is interesting. Another one of your cartoons where you talk about self-fulfilling prophecies, and I think this was again debated in the press recently.
Yes, so I mean, this has been a long critique point. I think for all disciplines, for some reason, it only seems to be used for TA. But essentially, I mean, there's two strands to this argument here. One, in all fairness, many people do use the 200-day moving average. It's a convention, just like in the UK, we drive on one side of the road. It's what we're used to, but we're used to because it's the yearly annual horizon, which financial professionals use, many economists, media will cite it, so it's regularly followed, and systematic traders, even Paul Jones famously talks about the 200-day moving average being one of his key tools to investment timing. And what it shows on the S&P 500 is a rising tide, the 200-day, has lifted all corrections since 2016. Since we actually crossed above the average, it's held every correction. So if you're looking to buy on the dip, this was a pretty powerful strategy. Now, it was only a powerful strategy if we used price and time filters, because of course the market did have intraday and sometimes daily closes beneath that average. So that's something we need to keep in mind, price and time filters. Otherwise it can get quite messy in a volatile, choppy market. But in terms of self-fulfilling, no one really uses one indicator. A technician will use a toolkit and not just one indicator, let alone other people who are using other strategies. The other thing is, even people that use TA or complementary to any other strategy, they'll have different styles of analyzing, they'll have different investment horizons, different risk metrics. So it's really improbable. And at the very end, if there was a chance, let's say lots of algo traders started doing the same thing because there is more volume in that area, it would be self-correcting in the near term. So it's really important to keep in mind each of those points. And the last thing I'd make, just as a humorous note, but actually something to keep in mind, let's not treat it as a self-fulfilling prophecy, and be aware that the market can, as much as it has held above this line for some time, it can break below. So let's not blindly trade the 200-day, whether we're doing it because we've made money or not, because we have to be, the longer it's held around those levels, the more chance it has to break it back again.
What about straight trend lines, be they channels or horizontal lines? How attached are you to that form of technical analysis?
It's how I began in the industry, and it's part of the semi-discretionary approach that I've used all along. But I've migrated over the years onto more statistical overlays that can that can basically tighten up the results, or in some cases provide some confluence. So if you get two non-correlated signals saying the same thing, that's a higher probability, and it's all about probabilities, not certainties, so it's a higher probability that the trend direction or the signal is correct. And so interestingly, whether you draw a trend line or a regression line, which most statisticians and quant or even economists use, you would have got the same answer. The line in the sand worked for 30 years, but now, as with all lines in the sand, at some point they can be washed away. And that's what's happening now on 10-year treasuries as we touch that 3% level. So we need to kind of just add some salt to that line in the sand and look at some of the horizontal levels, which would be my second point here, because they're even more powerful, because these are the real psychological resistance or support levels. Even when I look at resistance support levels, the horizontal levels, I will use more statistical analysis just to tighten it up again and increase the probabilities for that analysis. And this is looking at probability distribution. That just statistically measures each tick on treasuries. And right now it's showing that the mean, the average, is above 4%. And that doesn't mean that we get to see a long-term reversal. In previous interviews we've discussed this. That will be a glacier move that will likely happen over the next few years. Commodities will also need to turn into a secular bull to really fuel sustainable inflation, and many other things between now and then. But the key thing is it's more saying something about a spike risk into 4%, and there's many other technical and even macro overlays that are suggesting that for people who are open to that view.
Let's bring it all together and bring up your final chart and talk a little bit about how you apply it all. I mean, we have in the past spoken about cryptocurrencies, Bitcoin in particular. I know you want to talk about it now, but bring it all together and talk to us a little bit about the big picture.
Yeah, so going back to the point that nothing is used in a vacuum, whether it be a technician or whether it be any other discipline within the industry, using that holistic approach of everything that works. This is a picture that we had looked at in the past of Bitcoin, following its cliff drop from the December peak, which we spoke about ahead of time, 70% on the downside, and since it's been basically within this triangle pattern. So I think maybe the lead point here is patterns, and that's the difference now when we look at the Bitcoin chart. Now patterns from a human perspective, we're programmed to identify patterns, so it's something that we should all really understand and rely on. Also, notable studies out of MIT University by Dr. Lowe have actually automated patterns and seen practical value in patterns. But, of course, the pushback, and I understand this, is a picture or a pattern is in the eye of the beholder. And for that reason, it needs to have a context. And so that's why most technicians will jump on up and down about how a pattern needs to be part of a trend. Otherwise, it's an isolated signal. So there needs to be context. And here, although we were basically in a long-term uptrend in Bitcoin, we're in the corrective phase of that. Bitcoin failed to break above 11,000, which is a very important resistance level, but also statistical mean level on that probability distribution chart, which I just explained previously. And so that shows further loss of upside momentum and an increased probability, and it's probabilities, not certainties, an increased probability that we get further downside in Bitcoin. And with a daily volatility of 20%, this is not a good falling knife to try and catch. It's quite dangerous to do that. Risk management is paramount, and it is signaling a move into 3,000, and that's a target that we've been talking about in previous interviews. All that's happened is Bitcoin has basically taken a breath of air between the last time we spoke and now, and it's looking like it's about to roll over any time. The risk level, I must say, because everything has a stop, is at 97.50. If we break above that, that would neutralize the scenario. Also keep in mind the lower overlays, which show that there's a timing window, which is also suggesting further downside, and the momentum indicators have been in a bearish cycle for the whole of this year.
Yeah. Okay, Ron, we've got to leave it there, but thank you so much indeed for your case for technical analysis using some interesting up-to-date examples. That was Ron William from RWA Advisory.